I believe that the last 3 weeks are an indication that leadership in a bull market is switching from gold to silver. That has happened in my career when the generalist investors become attracted to the gold bull market. It usually takes the generalist investors 2 or 3 years into a bull market to come into the space. The price action justifies the narrative. When they do, my experience has been that leadership switches from gold to silver. We may be experiencing that right now. I notice that among the silver juniors, this increase in the silver price has led to an absolutely massive dilution campaign. The silver juniors that were starved for capital 3 or 4 years ago the floodgates are opening, and these guys are issuing lots and lots and lots of paper. Daryl, I always make fun of the government for counterfeiting, issuing phony paper. The private sector is always more efficient than the public sector. And the Canadian dealer network can issue more phony baloney share certificates than the government can currency. People who are concerned about inflation need to be concerned about the inflation in the share counts of their juniors. I'll caution you there. Yeah, no, much higher. Despite that, I'm selling some silver stocks. I'm de-risking. I'm a disciplined guy, Daryl, if nothing else. I have the ability to take a little bit off the table and de-risk my position into a mania. I'm in.
Mhm.
I'm in. I'm not saying that people should sell 100% of their silver positions. I'm not saying that. If you look at the Sprott Physical Silver Trust, PSLV, that trust is still selling at a discount to net asset value. When you have a silver bull market like you did in the silver squeeze, you will see that trust selling at 3 or 4 or 5% surplus to the silver price. It went as high as 30%, and you'll see it there for days at a time. So we are not yet seeing manic conditions in the silver market, which suggests that the best of it is ahead of us. All I'm trying to say is that if you're a contrarian investor, the hate period is over. And that stock that you bought as a consequence of an intention to sell when the material was no longer hated, that position needs to be sold. And I'm doing it. I personally own much more physical gold than silver. Not because I think that silver won't outperform gold. I do believe that silver will outperform gold. But I save in gold. I don't speculate in gold. I speculate in silver. So for me personally, I stacked way, way, way more gold than I have silver. I speculate in silver stocks as opposed to speculate in silver. That notwithstanding, I'm greedy like everybody else, so I do own some physical silver. I think it really depends on your personality. Let's just get it out of the way. I'm old, fat, rich, right? I don't need to do this for a triple or quadruple. I need to do it to maintain my purchasing power, and I need to do it for amusement. So for me, I have a large amount of physical gold, a lot, uh, some physical silver, but my speculative positions are in the silver stocks. My experience in the last 3 bull markets in my life suggests to me that when the generalist investor really believes in the precious metals narrative, that the amount of money that flows into the high quality silver stocks exceeds the market capitalization of those stocks. They really, truly explode. And I'll give you, Daryl, if you will allow me, some rather graphic examples. In the decade of the 1970s, when I came into the business, a little tiny penny dreadful called Coeur d'Alene Mines on the Spokane Stock Exchange entered the decade in 1970 at 10 cents. It exited the decade on the New York Stock Exchange at $65. Now, sadly, I was too inexperienced and too poor, frankly, to participate in that. But I was ready next time. The silver bull market that we enjoyed in the early 1990s, and it was a ripper, saw Pan American and Silver Standard, both of which I financed, grow from 50 cents and 72 cents respectively to over $40. And they did it in 6 years. That's an example of what can happen to high quality, repeat high quality, repeat high quality silver stocks in a silver bull market. There are probably 200 silver companies worldwide that purport to be legitimately in the silver business, and there's probably 20 worth considering. An assemblage of those 20 I expect in the next 3, 4, 5 years we'll do extremely well. As I say, I repeat myself, that notwithstanding, the fact is that I can, in the more speculative end of that market, sell a quarter of my position and keep the rest for free is
Hmm.
such that despite the fact that I think that the market is going up even in the near term, I'm de-risking. The volatility index right now looks like the electrocardiogram of a corpse. There's no fear in the market. And if any fear comes into the market and the VIX goes to 20, uh, you're going to have a very interesting time. They're called black swans because nobody sees them coming. Nobody sees them. So I believe in cash. Holders of cash need to understand that cash costs you money. If you believe, like I do, that the deterioration of the purchasing power of the US dollar is cruising along at 7.5 or 8%, and you're getting 4%, it means you're losing 4% a year. I believe that that 4% that you lose in negative interest is an option premium so that you have the liquidity to take advantage of market turmoil. You have the cash and the courage to take advantage of situations that would otherwise take advantage of you. The period uh, right after the 2008 crash, 2009, was the best investment year of my life because I had the cash and courage at the end of 2008 to take advantage of illiquidity rather than being taken advantage of. The tools gave me the cash, but perhaps experience gave me the courage to take advantage of that. So I like to maintain good liquidity uh, because volatility strikes, illiquidity strikes when you least expect it. And having liquidity when other people don't gives you the ability to affect a wealth transfer from them to you. I was a pretty aggressive de-risker in 2008, not because I knew that the crash was going to come. I didn't. I just knew that life had got too easy.
Yeah.
I had established a lot of those positions in 99, 2000, 2001, when most folks couldn't spell gold. And we had an amazing bull market in that decade. We had an amazing bull market, and life got too easy. And everybody was piled into the gold trade. And I just decided, you know what? There's a whole bunch of people who I'm competing with now who are likely smarter than me, and I'd prefer not to compete with them. So I got out of the way. I'll tell you a funny story. The 2008 was precipitated by, I would say, an overvaluation of real estate securities. And this will tell you how stupid I am, Daryl. I was driving on the 405 freeway in Southern California from San Diego up to Los Angeles Airport. And somewhere around Torrance or, you know, South Bay Turn, off on the east side of the freeway, I saw a great big billboard. This is 2007, I think. It said, borrow 125% of the value of your home. Bad credit, okay. And I looked at that sign and I thought, I'm a lender. I don't think borrowing 125% of what the collateral's worth on a bad credit is probably a very good loan. I'm not a real estate lender, so I didn't do anything about it. But looking back at that, that was a flashing red light. And by the way, it was Ditech Mortgage, which was a subsidiary of General Motors, which went broke. um, Despite the fact that I had that very, very, very dire warning, I wasn't stacking cash necessarily tactically or even strategically. I was stacking cash because the companies had met my valuation target and the market was eagerly, eagerly, eagerly buying paper. And I thought it was my duty as a market participant to assist the market by providing some liquidity. And it turned out to be a very fortuitous decision on my part. Warren Buffett described himself in a bear market as a kid in a candy store. He just can't decide which window he's going to buy. And that's where I was. Berkshire Hathaway, the finest general market securities company in the world, was selling at a 50% off sale. Buffett didn't get any less smart. He didn't have any less cash. He wasn't selling any less insurance. Just the price changed overnight. Franco-Nevada fell by, I don't know, 35 or 40%. Their royalties didn't go down. uh, ExxonMobil fell by 40%. Yes, I bought more gold stocks, but I bought everything. Uh, a wonderful bank down there, Farmers and Merchants Bank of Long Beach, financial fortress. fell by half. Uh, there was so much to buy, Daryl, and nobody wanted to buy any of it. Now, if I had been aggressive, which I wasn't, I would have bought calls on things like Citicorp. I would have bought, if I'd been aggressive, I would have thought, the political fix to this is going to work. And the companies that are most hated, which is to say the guys that have too much real estate equity, leveraged real estate equity that are too big to fail, are going to do the best. If I had been smart, I could have bought $5 Citibank calls for 10 cents each. And the stock went to 60 or 70 bucks. I could have made 100 baggers, but I wasn't that aggressive. I looked for high quality circumstances that were selling for half of what they were worth, where I expected that they would attain reasonable valuations in 2 years or 2.5 years. That's what I did. As it ended up, they obtained reasonable valuations in a year. And so I did extremely well. But the lesson is simply that having liquidity when others don't, if you have the courage and the knowledge to deploy it, is the best possible circumstance for your portfolio.